Imagine waking up to find that your favorite phone now costs 25% more. Your car, 25% pricier. That cozy Canadian goose down jacket, you guessed it, 25% more expensive. As of February 1st, there is a new reality that could shake the very foundation of North American trade. In this video, I'll take you through tariffs, what they mean to you, to our neighbors, and at the end, I'll give you some actionable insights to take away. Tariffs are taxes on imports that increase the price consumers and businesses pay for goods and services. In the United States, U.S. tariffs increase the prices U.S. consumers pay for imported goods, leading to higher inflation. U.S. GDP growth slows because retaliatory tariffs imposed by other countries, including Canada, lead to a significant substitution away from U.S. exports. According to the Bank of Canada, our GDP will contract 2.5% in 2025, 1.5% in 2026, and should be neutral in 2027. So what's the big deal? Well, picture Canada as a gigantic factory with conveyor belts full of our domestically produced goods aimed at sending them directly south across the border. As of February 4th, the US essentially decided to put a 25% price increase sticker on everything rolling off those belts into the US. So here's what actually happens. Canadian goods become pricier and less attractive in the US market. Americans looking at products on the shelves suddenly see certain imported products are more expensive than domestically produced ones. This could lead to a domino effect of job losses on both sides of the border, and both economies would shrink significantly, and inflation will definitely increase. Here's an easy example. Let's say you run a small maple syrup business in Quebec. Your $10 bottle of syrup now costs $12.50 in the US. Suddenly, Americans might think twice about buying your syrup, opting for cheaper alternatives instead. Now let's hop across the border and see things from the other side. At first glance, some Americans might think, great, these tariffs are helping to protect our domestic industries. But it's not that simple. US consumers will likely face higher prices on a wide range of necessities. Industries relying on Canadian parts or materials would have to pay more for the parts, and they'll probably pass that on to the consumer, potentially leading to, yes, more price hikes. Think about the average American. They have been saving up for a new car, partially manufactured in Canada, partially in the US. With the new tariffs, that $30,000 car now costs $37,500. They might have to postpone the purchase or settle for a less desirable option. In fact, specifically with automobiles, most of them are actually produced throughout the North American supply chain. So even a GM, Ford, or Chrysler car will still cost 25% or more to an American. Let's take a look at the big picture, the financial markets. Imagine the stock market as a giant roller coaster. We all know it goes up and down, but this tariff news just added a few steeper loops and drops to the ride. Stock markets on both sides of the border could see significant ups and downs. Canadian companies with important US sales numbers might see their stock prices fall. The Canadian dollar will most likely weaken against the US dollar. A few sectors might actually benefit in the short term, but overall, we're looking at a bumpy ride. Let's say you're invested in a Canadian auto parts supplier. Suddenly, their demand drops significantly, so their future cash flows likely will too. Since assets are based on cash flow, amongst others, the stock price will likely adjust downward to the likelihood of less revenue in the future. So what can you do in these uncertain economic times? Number one, stay informed. Keep an eye on trade news and how it might affect your job or your investments. Number two is diversify. Don't have all your financial eggs in one basket. Consider spreading your investments across different sectors and even countries. Now more than ever, it makes sense to have a low-cost index ETFs in your portfolio. Remember, the more concentrated your portfolio is, the more company-specific risk you take. And number three is engage. Reach out to your financial advisor to see their strategy and how they're planning to tackle not only this tariff issue, but also how they'll handle uncertainty in the future. Remember, in the world of investing, knowledge is power. So keep learning, stay adaptable, and you'll be better equipped to weather this or any financial storm. And if you found this video helpful, don't forget to like it, share, and subscribe for more breakdowns of complex economic issues.